Let's go like this here. Turn that off. How's everybody doing tonight? Welcome to Wine and Wealth, baby. Happy Thursday to you. We're doing this from here tonight because I want to be able to use the charts and share some stuff with you here. Welcome, Mike. 2 mics in the house. Jerry, how we doing? Tron. Cool name. You know, the Tron roller coaster at Disney is about to open. WV. Bruce, my man. Swamp Rat. How you been, Swamp Rat? Excuse me. So this is just loading up here. Just making sure everything's going good. Welcome to all of you that are here hanging with me tonight. As always, I'll do like I tend to do, and we'll go through everything. I'll stick around and answer questions as long as you like, but do like to be respectful of most of the people that watch the replay and do not or cannot join us live here, which is a shame, baby. Grab your glass of wine or your favorite. Tonight going with the Hotel Tango. So whatever you got, join it. I don't know why we call it Wine and Wealth, to be honest. It's often not a Wine and Wealth night, but I hope all is good with you guys. Jerry's going to Disney in a few days. I was just there, not last weekend, because it was kind of nasty the weekend before. We didn't go in Disney, but we went to the, so if you ever are there for a few days, actually, and you're looking for something else to do, the Disney Boardwalk. Nice little place, kind of where most people don't go. Nice and calm. Get yourself a nice little something to eat. You can see the Epcot fireworks from there. You can see Magic Kingdom fireworks from there. You can tour all the hotels and stuff without having to pay those high Disney dollars. You know what I mean? Tonight is Whiskey and Wealth, and we're going to talk about covered calls. You know, this is becoming more popular. You guys, I notice, I track all the emails that come in. I was actually going to do a video of that just to show you how many people email, what we talk about, how long it takes to get back to you and stuff, all the stats there. But I don't know if that's really that interesting to give you the behind the scenes look. But I track all the emails to really look for themes. What am I not doing a good enough job explaining? What can I add value to for you? And since the market has been bouncing this year so far, I noticed a lot of you are selling some covered calls. I'm getting a lot of questions on this. So this is not a class so much as how do they work. We've done videos and classes on that in the past. You could certainly search for that. Just search options, I believe, in the dojo. But I'd like to talk a little bit about what happens after and during your exposure to having a covered call. And then we'll cover some of the details as well. So there are 3 things that can happen when you sell a covered call. Ready? The first is that the stock can go sideways. Nothing happens, didn't go up, didn't go down. That's been common actually through the month of February so far. The second thing that can happen is you could have been early and the stock price could continue rising. That's the most confusing one if you're looking on your P&L statement, however you see that on your platform, that tends to be the most confusing. The easiest thing that can happen, although sometimes not the most comfortable, is you sell a call and the market or the stock goes down. So I want to talk about each one of those today, and we're going to start with the first one because that's kind of the easiest one, one of the easiest ones. You sell a covered call and it goes sideways. Right. So you should still be able to hear me, see the charts. We're going to pretend here, because I've had Disney for a long time now. It was the last of a position I've owned. I've got a kind of a simulated environment here so we can still place orders if we get that deep. But let's pretend you own shares of Disney and you sold a covered call. You chose your strike price at $110. Now remember, I'll just pick April, for example. Remember, you can choose your strike price. And so on the left, we have calls. On the right, we have puts. And so we're going to pretend we own the stock at any price below 110. And we've said, look, it's going higher, and I'd like to sell a $110 call. Now, if between now and April, the 3rd week in April, which is 64 days, as highlighted there by my screen there, if it stays below that for that duration of time, sorry if it's a little bit weird. I'm sitting down tonight. You know what I mean? I might stand up. I don't like this. If Disney stays below $110 for the next 64 days or for the majority of those days, then you stand to profit at the moment the $3.60. Okay? The whole amount is called its extrinsic value, or its time value. In other words, the $110 strike price at the moment has no other value other than time for this person to be correct, whoever bought it from you. The stock price is below $110, so there's no value to this product as long as that happens. And so day by day, you're going to notice this value drop. Again, that's provided that Disney goes sideways, or maybe falls a little bit. All right, so as tomorrow goes, and Monday and Tuesday and so on, your $3.60 that you potentially sold it for starts to dwindle down to $3.50, $3.40, $3.20, and so on. But that represents a profit for you. Because remember, you're the seller of the call. So by selling a call, you collect the $3.60 on a product that has no value at all, kind of like Bitcoin, right? So as long as it stays under 110, you're fine. That's the easiest thing that can happen. Now, over the course of 64 days, 63 starting tomorrow, we're actually going to have Disney not go sideways. It will likely go down, then up, then down, then up, and pick a direction wherever it wants to go. And so going sideways, we're letting time, or the extrinsic value, if you want to look that up, just dissipate, go down to nothing. And the reason for that, the easiest way to explain it is, over time, this person who bought this call from you is becoming more and more wrong. I always use the example, if I were to bet you that by next Friday it will rain right on top of this studio, you give me $10 now, let's pretend there's 10 days to go, and for every day it doesn't rain, the value of your bet is going to go down by $1. So you give me 10, tomorrow it doesn't rain. Now, if you want to get out of that bet, I'll give you 9 back. You can change your mind. We'll call it, the bet's off, you can have $9 back. If on Saturday it does not rain right on top of this studio, I will give you $8 back. On Sunday, if it doesn't rain, I will give you 7, and so on, all the way to the very end. You could change your mind at any time, but I'm going to hang on to that $10. So that's kind of a little basic overview there. So that's kind of what's happening with the time value there. Now, let's take the other approach here. Let's say you sell a call and it's a $110 strike price there in April, like we saw, and Disney goes up and never looks back. This is the tricky one. This is where you guys tend to ask me questions. If Disney goes up, then for the moment, the person that bought at $3.60 is correct. Their belief is that the stock will go above $10 by more than $3.60, and so they'll be able to enjoy, hopefully, some profit. For the most part, you could also buy calls for the sake of selling them for some amount higher. You don't have to hope it goes over 110, but for our example tonight, we're going to pretend that. So let's say tomorrow Disney goes to 110, the next day 115, the next day 120, then 125, 130, and it starts rocketing away from you. The value of this will go up dramatically, and it looks like you're losing. So if we end up here at, say, 130 over the next week, the value of that call would be somewhere in the ballpark of $22, $23. So you sold it for $3.60. Come to find out next week, we're trading at $130. Now the value of this will look just like this, somewhere in here. Why is that? Well, how did we know exactly what it will jump up to? That is known as your intrinsic value, the difference between the strike price and the actual price. So now the option has a real value. And that's because the person who bought this call from you could now choose to exercise their right, call those shares away from you, and they know that they own them at 110. Well, if the stock price is trading at 130, they made 20 bucks. Minus what they paid. You still get to keep the $3.60. So let's round it up to 4 and say they made a $16 profit. And that's because of the actual difference in price. Now, did you lose? Anybody know? Did you lose on that trade? So let's pretend you own the stock anywhere under $110. You sold the 110 call, and wouldn't you know it, something amazing happened. It goes to 130. It looks like you lost. This is where the questions come up. I would spend the most time on this if you wanted to practice this in a simulator. This is the Thinkorswim simulator. You could download it as well. So what happens is the value of the call goes up to, say, $23. And that option looks like it's lost a ton of money, $23 for every, or $230 for every one contract that you sold, for every dollar. So you're thinking, oh my gosh, this is a big loss. However, if you own the shares, your shares also went up $20 per, share, or, whatever it is, $230 per 100 shares. So we have a wash there. We have a big loss and a big gain. At the end of the day, what did you do? You sold for $3.60. If you owned the shares of Disney at $110 and now it's trading at $130, you don't get to enjoy that profit. You have given that profit to somebody else in exchange for the $3.60. So it turns out, doesn't seem like it's all that great of a bet, right? But you didn't lose. This is where people get nervous. They say, well, oh my God, I sold a covered call. Now I lost all this money. This sucks. No, you didn't. You made $3.60. See what I'm saying? You could have made a lot more, but so be it. You made $3.60. So don't fall for that one there. That's the one that everybody gets tripped up on. Now, the other thing that could happen is you own your Disney shares at 110, you sell a $110 call, and it starts to fall. Now, let's do this. Let's say you sold it for I'm going to round up and call it $4, right? You sold the call for $4. Your average price on the stock is $110. That means you collected another $4. So your actual basis, your new average cost, is $106. See what I'm doing? Because you're holding on to the $4. You don't have to give it back if you don't want to. So if Disney goes from 110 to 106, which is basically where it's at right now, you look like you lost money, but you still haven't lost any money. You're break even on the whole trade. Because what happens? If you closed out the whole position, you've closed it for a loss of $4 on the stock, but you collected $4 on the option, and therefore you have no profit and no gain, although your P&L will not look like that. Okay? So a little bit different there. Now, let's try something here with the extrinsic value. And I'm going to look around real quick and just try to find something that may be, see if I have some of my, I'm looking for a stock that's right around the whole number. And I'm going to just go like this. Last price. Okay, what do we have? General Mills, maybe. Okay, let's do that. That's maybe a bad example. All right, General Mills is right around $75. So how much would a $70 call be trading for? This would be in the money, right? Because the stock price is above the $70. Should it be trading around $5? Yeah, right? If we were to, in fact, look at this expiration and we find the $70 call, the bid is $480 and the offer is $540. The middle price is about $5. There's a fraction of time value left in there. So $5 is the actual value of the option, and let's say that this 40 cents is the time value. Why is it so small? There's only 40 cents of time value left. It's because there's only one day to go. What if we go out to April and we look at the $7 call? It's really only worth $5. But because there's so much time for that person to be correct, there's an extra $1.50, we'll call it, in time value. Okay? So if you sold the $70 call, let's say you owned it at $75, and for whatever reason you sold the $70 call, you do not make $6.50. You only make $1.50 in this case because the time value is only $1.50. In other words, your time value is only $1.50, right? So the best you can hope for is that over time, this wiggles around and stays right about $75, and you lose the $1.50 in time value, and the option becomes valued just as we see. We're running out of time here. Let's pretend that the April now turns into 1 day left. You're basically out for $5. By the time you get this order filled, it's $5. Okay? So let's go back to Disney for a second. There we go. So would we ever own a stock at $110 and sell a call less than $110? Probably not, right? Even if you wanted out of the position and I just wanted this to be done, you would still sell the $110 call at the money or above. for selling calls. We don't sell in the money calls as its standalone trade. Like there's other trades you can do where you would of course sell an in the money call, but as a standalone, I would like to do a covered call. I would only sell that 110 or higher. Now, how far out do you go? Would you sell, this has got 1 day left to go. Would you sell the 110 call today? No, because it's not really, and we could actually go tighter, right? So the stock price is trading at 106, let's call it. The $106 call only has 70 cents, I'm meeting it in the middle there, just splitting the difference, has 70 cents worth of time value. So in 1 day, tomorrow and tomorrow alone, if the stock price stayed under 106 and you had sold a call first thing in the morning, let's say, it'll be less than this, it'll be like 60 cents, but and you did that, then this is the most you can make in 1 day with the potential of having to give up your shares. Most people wouldn't do that. So that doesn't make sense. You'd have to really want out of the trade, maybe be in the middle of a margin call on something else, or you'd have to be in a little bit of a predicament, right? So most people would say, let's go out to the next month. What if I sell? I could sell the 110 call for $1.88. That's what you keep. That's all time value there. 105 is not the case. There are 83 cents currently of actual value, and the rest of it is time value. You get what we're doing there? Okay, so the big three things, the big three sort of takeaways there are we have know what to expect if you sell a call and the stock continues to go up. Know what to expect if you sell a call and it becomes like a snoozer. There's just nothing going on, right? And know what to expect if you sell a call and the stock price goes down. Which one of those may cause you to make a decision? Probably if the stock price went down. Because otherwise, we sell calls because we're hoping to maybe exit the position and collect a few more dollars on the way out. If the stock price goes down, there's that funny little spot where the value of the call has lost a little bit of money, but not enough to offset what the pullback in the stock is. That's where your volatility component comes in. And so that's the only side of the trade where you might say, I'm done. I changed my mind. I'd like to get out, right? If it's a long-term position, you really don't care. I've had Disney since last year. I was just telling you guys about that. I have 400 shares left, and I've had it. I've sold the 110 call, by the way. So since the last time we spoke, I had still had the 110 call. It went above it, but it's since come below. And I don't really care if it goes up or down. I'm just going to keep selling the calls. So my actual cost basis now is like under the prior low. No, it's not. I'm sorry. My cost basis is like 87 something. It's not under that. I lied to you. And so I don't really care if it goes lower because I've sold calls so many times. Every time you sell a call, you lower your basis. That's the last piece to this puzzle. So I'm going to take an example. You own a stock at $100. You sell a call for $5. And you're not called away because the stock price never went above your strike price. So what's your new cost basis? 95, right? You got to keep the $5. You owned it at $100. So your platform is still going to show you $100. You're going to collect the 5. You got to keep it in your head. My cost basis is 95. What happens if you sold in the stock, the price of the stock fell, say to 90 bucks, and now you sold a $95 call? Are you losing money yet? No, right? It looks like you're losing money, but your average cost is now 95. So if you sold a $95 call for $2 or whatever, now you've collected another 2. So your average cost is $93, right? You've worked off your cost basis a little bit. And so then you don't really care. If it goes above $95, you're done. And you made a profit, even though you sold the stock for a loss. That's why people love covered calls as much as they do. The trick is, just like most of us probably don't have an actual stringent budget, right? You don't have to try to sugarcoat it. I watch you guys in Nest Egg. You don't have an actual budget. You're kind of like, I know my numbers. Don't worry about it, right? Just like we do that and we sort of fudge that, most of us won't keep track of our cost basis. That's a shame, right? I don't know exactly what my cost basis is on Disney, but I know it's 87 something. I'm close. But you got to keep track of that. Otherwise, if you own a stock for the long term and it goes down, which it'll eventually do, you're going to think you lost on the trade. That becomes dangerous when you do your taxes or when you get shocked with your tax bill and you're like, I didn't make a profit. Yeah, you probably did. All right. All right, let me take your questions here if you have any. J-Dub says, if it's Roku, I lose regardless of this. Yeah, Roku's just doing its own thing, man. Today was great, and it's moving in the right direction. It's up like 70% this year, but that doesn't really help just yet. We're headed in the right direction. Mr. Pangy, well, that's a neat name. I'm looking for some insight into Tyson Foods and the rest of those stocks. Wonder what Dustin, that's me, thinks about these companies and their current stock price. Tyson is difficult. I don't know. So you got to be a little more, help me out here, be a little more specific about, are you looking to buy, or do you own them and you're worried maybe about Tyson? Should I hold it? Should I sell it? Whatever. Or is it something you're thinking about adding to? So if you'll help me with that, I will go through those with you. Curly Q, is that a Mickey Mouse glove behind you, or a big fan of Hamburger Helper? Yeah, we have two of them. Yeah, that is Mickey Mouse. Yeah, my mother-in-law got that for me. She got two of them. One's in the back. We keep it by the gym when we're working out. Is the profit from selling a call short-term capital gain? So it is, because you're selling within, or the trade will end itself. I can't grab my words, but the trade ends at expiration if you don't do anything else beforehand. Most of us will not sell what's called a leap, meaning we're going to sell a call a year and a day plus in the future. So for that reason, yes. When would it be a good idea to sell an in-the-money covered call? Yeah, so I touched on that a second ago. I can't think of a good reason why you would do that. It would have to be on maybe like a multiple leveraged ETF that wildly swings in both directions, and you're just trying to nail like the best you can to get out. Very rare, if any, that you would do that as just a strictly standalone trade. I don't know why you would do that. Oh no, child abduction alert. Oh man. All right, Brent says, curious about your take on when the price exceeds the strike price, roll the option, exercise puts, and get shares back. So this is a great question, actually. It's one that I've gotten a lot. Thank you. I forgot to answer that. If you're doing it for the sake of income, you don't want to let go of the shares, right? So there's two approaches you can take to selling a covered call. I've had these shares for a while, I'd like to sell some covered calls. That's great. I don't want to get exercised because maybe I haven't owned those shares for more than a year, right? And I want to get that long-term capital gain if I have it. So your idea would be to roll. And the way you're going to roll is you're going to actually look to do it for, as long as you can do it for a credit, then you keep doing it. So let me see if I can give you an example here. We're going to have to use 105 because Disney's trading at 105. So go over here. So let's pretend that you now have sold the call at 105 and you're nervous. You think it's going to stay above it or whatever, and you're considering rolling. Well, you go to your expiration. So let's say this is your expiration. We're at 105. If you had to buy back the calls, you've got to buy them for, say, $4.10. If you wanted more time, say you want to go from March all the way to April, so I need more time. I'm going to buy them back for $4.10. Come back over here, I can sell them for $6.10. So I can make $2 by buying myself more time, right? So in that case, you could roll. Would I roll? No, because I still get a credit. So what I would do is every couple days I would say, where's Disney now? And can I still roll for a credit? Every single day, this number, this spread is going to tighten up. So we may look at it in a couple days and find out we can only get $1.50 to roll. A couple more days later, or maybe even a week, 90 cents, a little bit further, 75 cents, a little bit further, and so on and so on. Depends on what the stock does. As long as I can get a credit, I'm willing to hang out. Now, when it gets to a point where you're within 20 days, you will find that the probability of you getting called away goes up. And so therefore, I would roll anyways, and you would still be able to get a credit, so it wouldn't be a big deal. What is that? Oh, it's a piece of dust. So that's the answer. If you're trying not to get called away at the 20-day mark, check to see if you could still get a credit, and I would consider rolling. If it's earlier than that and you're really nervous, could you roll out and up? This is not always possible. You usually need some kind of volatility in there, like earnings, which Disney doesn't have. So watch what happens here. If I bought back the 105 and I said, I think it's going to go to 110, I'm a little worried. If I bought that for $4 and I sold the 110, that's going to cost me money. I'm selling for less than what I paid, so you couldn't roll out and up, which is also common as well. The other side to that is if you're cool, I'm ready to get rid of the shares anyways. Like myself personally, I've sold the 110 calls. I will not be rolling. It's either going to expire worthless because the stock price stayed under 110, or I am in fact going to just let myself get called away. I'm happy to do that. So it depends on where you're at in the life cycle of your position to decide what you would do. JW, if you start going deep in the money, do you need to roll sooner than 21 days subsequent roll? I mean, I guess so. I would still use the 20 days. Going deep in the money before that, what was it? Like you held past an earnings or something? That would have to be some kind of earnings thing. I don't know why you'd be forced to do it early. Now, if you sold like a 90-day out call and you got ahead of yourself, you don't have to go that far, by the way. But if you sold something 90 days out and maybe something in between then happened, all right, yeah, I get that. Then it's not a matter of time. Tom says, what are your thoughts on a poor man's covered call, selling near-term 30-day out of the money call against long deep in the money? It's exactly what it is. It's a poor man's covered call. You don't have to go so far out. You can go to the next expiration or 2 out. You don't have to go a year out to do that. Depends on how active you want to be. Some people like to treat it as more of like a investment, long-term kind of a thing. And so that's why there's a spread between your front month strike, your front month expiration, and something way distant in the future, like a full year out. But I have no problem with that. It is a legal and well within the rules way to do it with using less dollars. You having that problem lately, huh, J-Dub? You sell a call and then you get the move, right? By the way, you don't sell a call on a down move. Think about that. Is there any pressure for you to sell a call tomorrow or today? The market went down. Most things went down today. So is there any pressure today for you to sell a call? No. You have the stock. Your stock does not have an expiration date. You wait until you think that sucker's like, why are these people so excited to buy Disney? That's crazy. Earnings, oh my God, they're so exciting. Roku, oh, everybody's so excited. That's not the bottom. This thing is not just going to rocket back to $200. So you wait for your opportunity. As the stock price goes up, the value of those calls go up too, right? I want to sell up there. I don't want to sell while it's going down. You're going to force yourself to take too little of money. Mr. Pangy says, I have some Tyson, but not sure of the strength of the company. The strength of the company is fine. In the short term, the price of the company is what you would say undervalued. It's essentially a value stock at this point. So there's no good reason for Tyson to just turn the corner and start rallying higher. It had its chance, and its chance was earnings. There we go. Its chance was to prove itself here with earnings and say something good. It did not do that. And so because of that, there is no urgency for someone to come buy this stock. So that one I would not be ecstatic about. Swamp Rat, who took Eric? Yeah, we fired him. Too many errors around here. By the way, if you tried to get on my calendar, that was Eric's fault too. He blocked his time off because he had to go out of town. And when he blocked his time off, he somehow checked a box that blocked off my time as well. And I didn't put it together. Like the other day, I was like, I feel like I should be doing something. Like it was really weird. It was quiet. I'm like, did I say something on the closing? Is everybody mad at me now or something? And then I noticed that the times coincidentally went together. I'm like, why is that? And then I asked him, he's like, oh, I'm sorry. So another error from Eric. Actually, I didn't mind. Any more upside in WBD, or should you dump it? Why would you dump it? And when you say dump, I assume you're taking a loss. Most people don't say that when they're taking a profit. Are things not just getting going for them? Is this not, in the industry as a whole, are things not starting to wake up? Fox, Warner Brothers? Plus, I can't hit the button. There you go. Plus, think about I'm going to stand up. What happened? The market has been going down Oh, yeah, I'm going to be cut up there. The market's been going down, but what did Warner Brothers do? It won't pull back. Isn't that interesting? So Warner Brothers refuses to pull back while the market is pulling back. Is that not relative strength? I think so. So for me, I would not, yikes, I would not sell that one or dump it, in your words. Dakota says, if you hold a position that has gone down below the cost basis, accounting for your previous call income, do you keep that adjusted cost basis the next strike price you sell a call for? Yes, you got it. Now, there may come a time, I don't know if this happened with Disney, but there may come a time where you choose not to sell a call because you can't get enough to bring you back to even. You'd have to be pretty upset or willing to take a loss at that point. If it was the end of the year, all right, you're trying to get some losses on paper, I get it. But yeah, there could be a time where you say, I just need to wait for the stock to come back a little bit so then I can sell a call. Mr. Pangy, if you buy a call and then exercise it, does the holding of the stock regarding long-term capital gains start when you purchased the option or exercise the option? So I think what you're saying there is, I bought a call in, February 1st. I chose to exercise it on March 1st. How does the capital gains work? I bought the call, I started the position on that stock, and then I ended up acquiring the stock. Your acquisition date is the day that you bought the call. And if I misunderstood your question, please let me know, because there's a good chance I did that. Mike, is there a preferred time frame, week, month, or more? So I think you mean when you're selling a call. Is there a preferred expiration date that you want to use? So anything around the 60-day mark is where you want to be in this market. And let me say it that way, it's this market. Just because of the back and forth nature of this market, we're in the middle of earnings season, we've got a lot of Fed movement and stuff. So I wouldn't go any further than 60 days, because what you'll start finding is, you go back to that class we did a couple weeks ago on return on capital. If you can collect $5 over a 60-day time period, but you can collect $6 over a 120-day time period, that's an extreme example, but which would you rather have? How much profit per day could you make, assuming the stock price went sideways? And I'm going to follow up with that by pulling up the calculator to explain. So if I could make $500, because that's really what it is, over 60 days, I've got $8 per day, $8.33 a day that I'm going to make. Or if I can make $60 over 120 days, that's $5 a day that I would make, all things being equal. Where do you want to be? I would rather be at the 60-day mark and make $8.33 a day versus $5 a day and have to wait longer to get my $5 a day. So what happens is, if you go too far out in time, your daily return on capital starts dropping rather quickly. And so most people would say, I don't want to go any further than that. That changes, by the way. In the summer months, going beyond 60 days is typically easy to do, and you'll still have about the same return on capital, but giving yourself more time. Great question, though. Iroku puts got executed deep in the money last year, and I just couldn't keep rolling long enough. So wondering if there'll be a better roll timeline once you're deep in the money. Yeah, it's a good question. I don't know. Roku's a bit of an interesting example, because if a stock price moves in your favor to the tune of 50% like Roku did, I don't know that there's much you could do unless you rolled that day, because you're likely to get assigned on that day. I mean, or called away on that day. It could be true. I don't have much experience with that, so I couldn't say that there's a good thing to do. If you want to keep the stock, then I'd say the best course of defense is an immediate offense, meaning roll right away. But yeah, that's a good. That's one I don't have a great answer for. But if it were me, I'll be honest. If it were me, if Disney went to $130 tomorrow, I would try to roll, just to see if I could. And if I couldn't, then I would just leave it. Remember, now, last part. Remember, if you have Disney shares at 110, you sell the $110 calls and it goes to 130. If you get called away, say tomorrow, you just start again. right? You could still buy the shares and sell the calls right away. You would essentially restart your position where you're at. So don't let, that's maybe more of an advanced thing, but don't let being called away change your ultimate cost basis. You're going to start the game back over again. It's just now you have a higher basis on the next round of shares that you buy. Yeah. Well, thank you, Mr. Pangy. I hope you learned something. I don't recognize the name, so we'll take it that because this is still done on YouTube here, that you're not totally new with us, but hopefully I was helpful for you. All right, so that's a look at that one. What we're going to do is I'm going to kind of gauge the emails still, and if we find that this is still a topic you guys want to talk about, then what I'll do is just start building a bunch of positions randomly, and I will sell calls randomly so that when we come in here, we'll just see what we have. We're going to inevitably have some that fell and moved against us, some that moved higher, some that are in the money, and we'll kind of model that out. But yeah. You think a pop and fade in tomorrow's markets, so that means a drop all day and then pop tomorrow? I would think after today, the activity today, the comments from the Fed today, the inflation numbers that came out today, I would think you would need something to convince people that starting a new position or adding to a position is worthwhile to do on a Friday before a 3-day weekend, right? If the Fed just started talking today and they're hinting at this half-point hike, well, I don't know that I want to start a new position on a Friday, and then Saturday they talk, Sunday they talk, Monday they talk, maybe, and I got to come back on Tuesday and see what happens. So it could be interesting. You got 600 shares of IBM. It pays dividends. Should you sell a call before the dividend or after? If you own a stock that pays dividends and you sell the call, you are technically not entitled to the dividends. You still get the money because you got it from the premium in the extra dividend premium in the call. However, you wouldn't actually, the person that bought the calls, they get your dividend. So there's a fun fact for you. If you're ever looking at your statement, let's say you did it, right? You sold 6 calls. And ex-dividend day comes and goes, the pay date comes and goes, you look at your statement and you don't see a dividend payment on there. Don't call your brokerage firm and yell at them. That's because you weren't entitled to the call. You chose to take the dividend money in the form of the covered call. After the dividend is paid, the calls become worth less, usually by the amount of the dividend, because there's no more dividend risk in there. I know you would love that, J-Dub. I know it. I know it. It's just a time thing. Well, if Eric keeps canceling all my calls, then I guess I'd have plenty of time to do that. This week's been fun. And I'm sorry, again, if you did try to book a call and you saw it was next week, you know, I'm here and we'll be here, but you don't have to wait if you don't want to. I don't have a way to alert everybody for that, but all right. Different type of class. If you're brand new, it's the first time you're joining us and your head is spinning, maybe visit some of the covered call option videos that are out there. However, we do not talk about this all the time. This is just based on the questions and feedback that we see coming through the emails. There are plenty more things that we can cover, and of course we will. If there is something that is intriguing to you, mind-boggling to you that has to do with the finance world, and don't be afraid to just email and say, hey, class topic, just throwing it out there, because that hits our system. That's something that I will see, even if you send it to Eric or if you send it to support or anybody. I promise you I do see it. And that helps us develop class ideas. So it's like, think of it like a little survey that you can just make up as you go. And we'll likely be doing a class on that. All right, let's wrap it up here for the evening. I appreciate you guys hanging out with us, and a little tower of power to wrap it up, huh?
So I can